about any kind of feedback. Yeah, so thanks Neil, Dima, and Christian for giving us the opportunity to present this here. This is joint work with Adrien, Christian Schlag, Martin Waibel, and Chunjie Wang. And since Martin is now at the Fed board, I get to say the first time the Fed disclaimer that these are our views and not those of the Fed. This is in this paper, we ask a fairly simple question. Suppose you have done thorough research and identified a bunch of stocks that have a high expected stock return over, say, the next month, and some stocks that have a fairly low expected return. Now you have at least two choices how to implement your insights. Obviously, you can buy the high return stocks, high expected return stocks, and sell the low expected return stocks. Or you could maybe trade options on them. You could buy calls on the first group, sell calls on the second group, or vice versa for puts. And if you talk to people, you know, they understand this is not exactly the same, but those two things should be close substitutes. And that's also supported by standard option theory. In any standard option pricing model, the prices are independent of the expected return of the underlying, but payoffs obviously are not. So therefore, you get a strong exposure to the underlying if you buy a call or sell a put. Somewhat surprisingly, that has never been tested in the data. So that's exactly what we do. And what we find is you actually cannot really well extract the risk premium of the underlying stocks using options. The returns you earn are fairly low, and you're much better off trading in the underlying stock market. And a side result of that is that we find option prices, single stock option prices, do actually co-move with the expected return of the underlying, simply called mu in a model like shows. And that's a fundamental property of these models. However, we find this to be violated in the data. Let me show you this main result in a simple trading strategy. So I show you this in two steps. First, we need to figure out what stocks should we buy, which stocks should we sell. We do this in a replication of the Gu et al. Paper. You probably know the paper. It applies machine learning models to extract signals about future expected stock returns. We use their three-layer neural network as a benchmark model, and everything we do is out of sample. And what I show you in this plot is only the subset of optional stocks, so only the stocks that you later also have options data on. And we train the model using a full sample, and that each month we have a signal out of sample, what's the expected stock return, and then we buy the 10% highest expected return stocks and short sell the 10% lowest. Repeat this each month, and the resulting trading strategy, the cumulative returns, is what you see here in the blue line. It's called ESR, is expected stock return sorted stock return portfolios. As a benchmark, I have here a naive market strategy where we just equally weighted naively buy all the stocks in the sample, in the optional stock sample. And you see on average, the blue line does much better than the market, returns on average 204 basis points per month, while the market over the risk-free rate returns 70 basis points. So it's about 3 times, the strategy does about 3 times what the market does. Now comes the next step. Once we figured out which stocks we think are good, which are bad, instead of buying the stocks, let's trade call options on them. We show this here using at-the-money calls. We buy them monthly and hold them until maturity. And we buy calls on the 10% high expected return stocks and short sell calls on the low expected return stocks. And the resulting trading strategy, the cumulative return, is what's shown here in the blue line. It's scaled to have the same volatility as the stock return. And you already see it doesn't do as well. Before we went up to 4 in log levels. Now it only goes up to 2. The first benchmark, to put this in perspective, I have here on the slide is, again, a market return. So in that case, the market is just naively buying all the call options, all the at-the-money call options without any further information. And that's the black line, and you see already this super simple strategy does better than the fairly sophisticated one that uses the expected stock return as signal. And to really show that this is a poor performance of the call return strategy, we derive a lower bound a model-free lower bound, how high the returns actually should be. So it turns out that if the stocks perform as 3 times as well as the stock market, then also the call spread, the spread between high and low expected call returns, should be about 3 times the average call return or the market return. So that's the red line here in this plot. That's basically 3 times the black line. And obviously, since this call strategy doesn't beat the market, it doesn't beat 3 times the market. And I will later show you that this is statistically significant. So a key takeaway is, if you do that, if you trade calls instead of the underlying stock, you do much worse, and you would be better off trading the stocks directly. I show you later on similar results for out-of-the-money calls, and I show you results for puts, and we find very similar results there. Alrighty, and yeah, this is already said. So a brief overview of the related literature. First obvious related literature is the cross-section of option returns. There are many papers, many authors are here in the room. I apologize if I forgot your paper. I try to put the most that I'm aware of on the slide. Many papers look at delta hedged returns that obviously try to hedge out the effect of the underlying. So that's maybe not what we want. We look at the hold to maturity returns because we specifically study systematically the link between expected stock returns and expected option returns. And then there's growing literature on machine learning and asset pricing. What we add to this literature is that we look at the hold into maturity option returns. Lastly, there are papers on mispricing of options, that they may be driven by other factors like demand. A related paper is here by Kremers and Weinbaum. They find implied volatility, put call parity violations that they predict future stock returns, and they attribute this to insider trading. We have a similar result. We also find put call parity violations, but we find they're strongly driven by expected stock returns. All right, that was a high-level summary of the paper. I will next briefly show you more details on the lower bound, more details about the data and how we test our bound, and then we can talk about potential explanations. So a key property that I already alluded to that we rely on is that an option price in any model is independent of the expected return of the underlying that I just referred to here as mu. So I show you this for calls, but they're similar for puts. An expected call return is just the initial call price, the expected payoff under the physical measure over the call price, and we do this as excess returns, so we subtract here the risk-free rate. And in any model that we're aware of, the partial derivative of the call price and the put price with respect to the mu, the expected return of the stock, is 0. The proof of that is fairly simple. Just recall any of these formulas. You probably know Black-Scholes very, very well. In the Black-Scholes formula, there's only the risk-free rate, no mu, so the price is independent of mu. But obviously, expected payoffs increase in the expected stock return. You just shift the distribution to the right, so that increases expected call returns and decreases expected put returns. Now, to be a bit more formal, we have this lower bound, and for that I need to make a bunch of assumptions. The first one is the one already illustrated. Option prices or call prices don't depend on the expected stock returns. And then I have to illustrate this 4 hypothetical stocks. Suppose we have a high return stock, a low return stock, H and L, and in between we have a stock with the expected return equal to the market M, and we have a stock with the expected return equal to the risk-free rate. And I have this strange assumption here that basically says this must be a mean-preserving spread. The HML spread must be mean-preserving relative to the equity premium, or it can be shifted upwards. Then I clearly need to observe some calls, European calls with the same relative strike and maturity. And for now, I'll say all else equal, all these stocks should have the same distribution, except for the mean. And then I can derive this lower bound that I mentioned before. Then the spread on the expected call returns should be at least as high as the market return scaled with this ratio of the stock returns. So the HML spread over the market spread. So what does this tell you? So with this inequality, we don't have to take a stance on the model. We don't have to say core return should be this or that high, but we just relate them relative to the average core return. It's a bit like if you want to test the CAPM, you don't need to take a stance on the equity premium, but you say a stock with a beta of 2 should have double the excess return of a stock with a beta of 1. That's kind of the spirit of what we're doing. And the only thing you need to derive this is convexity of core returns, which holds in any model that we are aware of. Let me briefly illustrate how this looks in standard models. We have here the Black-Scholes model, the Heston model, and the Bates model. I've here slightly rearranged that thing. So I've divided that bound by that thing. So I have the ratio of core returns relative to market. And the bound is always the dashed line. This ratio is close to 3 in the data. It's 2.94. And this is also how I've calibrated these models here. The true ratio, the true value is the blue line. And you see for in the money, this is a super tight bound. For out of the money, this diverges a bit. But again, it's a bound that always holds. Then we also want to see something on puts. For puts, it's a bit more tricky. We have the following result. Under the same assumptions as before, we find that the spread in put returns should be at least as negative as the spread in the market return for puts. So put returns are always negative. These are two negative quantities. This bound is actually fairly slack, at least in models. A good approximation would be something similar to what I had before, where you have here the spread in put returns should roughly be proportional to the scalar of about 3 times the market for puts. Let me briefly show you this in the same models. The bound I will test is this dashed line of 1, that this ratio is 1. But you see here, this is fairly slack. These ratios are actually pretty close to 3 in all models. Okay. Should I stop here for questions? I see something popping up in the chat.
Oh, that in the chat, I think, was Dima's link to your paper. Let me ask a question now that you invite them. So do your stock returns include the borrow fee you'd have to pay to short sell the stock?
We have this in a robustness test, and the results don't change much.
Okay.
But not in the benchmark.
Anyway, does anyone else have a question? Oh, so go ahead.
In the option returns, what role do transaction costs play?
In the benchmark, none, but we have calculated them, and the result comes out even stronger because the options are more affected by transaction costs than the stocks.
Yeah, I'm asking the question because there's an old paper like Wilmot 94.
Yeah.
You know that paper? It's like in Risk or something like that. But so it has kind of a cute result where the bid ask depends on the drift of the underlying. So the friction does depend on the drift of the underlying, and it's not symmetrical due to the convexity effect. And so in the end, I'm not sure how that plays with kind of fair value and whatnot, but anyways, so
yeah,
maybe
it's a good point. I took that down. I'll take a look. Thank you. All right, then I move on. Data is fairly standard. We use standard stock and firm level data, CRISP for stock returns, Compustat for accounting data. We use the full sample to train the machine learning model. And then, as I said before, we only look at returns of optimal stocks. Option data is option metrics data. Our option returns are held until maturity. We buy them on the first trading day after the third Friday, so typically the Monday, and then we hold them until maturity. Benchmark will be at the money, defined as plus minus 10 percentage points away from a ratio call to strike ratio. Sorry, strike to a spot ratio of 1. and out of the money outside. We only keep one stock per underlying, typically the one that's closest to the threshold. And that's obviously different from delta hedged returns. We want to maintain the exposure to the underlying in order to be able to study the link. A slight thing that we'll talk about later in more detail, the COVID-19 market crash is a fairly large outlier when it comes to put returns. They are 10, 20 times as large as they usually are, up to plus 300%. So most of the results go through regardless, but sometimes we exclude them because we consider this non-representative. Some brief summary statistics on our sample, here for just focusing on at-the-money calls. They have an average return of 4.9% per month with a standard deviation of 180%. If you compare this to stocks, this is about an order of magnitude larger, standard deviation pretty much exactly, average returns close to 10 times as large. Time to maturity close to 1 month, at the money, implied volatility on average 46%, and a delta of close to 0.5. Then for our machine learning, we need a bunch of characteristics to predict future returns. We basically replicate here the Gu et al. Paper. We use the 94 stock characteristics. We add 5 additional ones, mostly skewness and kurtosis, because they might be relevant for options. We have 48 industry dummies. And then for options, we have 80 option characteristics that are used in the paper of Bali et al. In total, this is 227 variables. Now, what I said before already, the expected stock return is kind of the key variable in our study. We follow Gu et al. How to do this. We train our model in sample with training and testing, and then we do this, all the prediction and trading out of sample. And we train the model on the full stock sample starting in 55, and then we do out of sample prediction from 2006 onwards. We have 2006 because sometimes we also do some machine learning on the option sample, and then we need at least the first 10 years of the option sample to train the model. Here's an overview of the results. The first 2 plots are the one I've shown you, that this strategy does fairly well in stocks. In particular, the paper was published in 2020, had data until 2016. This works equally well out of sample and even works better since COVID. And also, this is only the subsample of optional stocks. You might sometimes these effects are driven more by small stocks, which are obviously excluded here. So this is the strategy does fairly well regardless. The calls is the same plot I've shown before. What I've now added here is the puts, again scaled to have the same volatility as the stocks. The blue line would be now if you what is that? You sell puts on high expected stock returns and buy on the low expected stock return stocks, and the performance is then here the blue line. The market is the dashed line, and it's overlaid by the lower bound, because that's exactly the same as I told you before. And what you can see very well, what a massive outlier COVID is, how the market really crashed down here, and the returns are several order of magnitudes larger than any time before. All right, some numbers. This is first the stock strategy. Here are the 10 portfolios. The low stock return earn minus 49 basis points per month. It's monotonically increasing. The high portfolio earns 155 basis points, and the high minus low is 204 basis points compared to 70 basis points on the market. Standard deviation is kind of U-shaped across these portfolios. And I have a bunch of other results in the paper. Of all the results are fairly similar to Gu et al. I leave it at that. Now, how do we implement the test of our bound? We won't do this on a stock level because that's probably elusive. We do this using portfolios. Not very surprisingly, the high stock return portfolio will be the one that I also use as a proxy in my test of the bound. The low one will be the proxy for the low return, and I'll also make this the risk-free rate. Why is that? Well, the proposition doesn't use the risk-free rate per se. It uses a stock with the expected return of the risk-free rate. So this would fall somewhere in between the first and the second portfolio, but it's conservative and to use the first one. That makes our life actually harder. So we pick this one. And then the market is just the average across all these portfolios, everything equal weighted, and only one option per stock. Now, by doing that, our assumption is 2 is satisfied. We have a mean preserving spread that with a mean midpoint larger than the midpoint of the equity premium. We had this assumption all these options have the same strike. That's obviously not true in the data, but these things should average out by using these portfolios. The last assumption, the fourth assumption was they have the same distribution. This will partially average out. Clearly, stocks don't have all the same distribution. There might be some residual differences across these portfolios, and I will later address this using double sorts. So how does now the call strategy come in? Again, we buy calls on this stock portfolio, and we sell calls on this portfolio. The low stock return call portfolio does returns about 0.4% per month, and then it's monotonically increasing as it should be until somewhere here around portfolio 5, and then it decreases again, and the high portfolio returns 6.3% with a spread of 5.9 per month. Standard deviation is here kind of hump-shaped, and the market as a benchmark returns 9.7% per month, which is clearly larger than this year. Same for puts, same exercise. I've multiplied everything with -1, like a short position, to make this easier to read. Now, these put returns would be -5%. If you short them, you earn 5%. Then they're monotonically increasing as they should be, but then again, they go down towards the end, and you have a high minus low spread of only 1.4%. Standard deviation, again, hump-shaped. And the market benchmark is 4.7%, clearly larger than this 1.4. So let's move on to the bounds. Just a reminder, that's what I want to test. I want to test whether the spread in call returns is at least the scalar, which turns out to be 2.94 in the data, times the spread on the market. And same here for puts. Here are 2 typos. This should be the call market. This should be the put market. Sorry for that. And whether this spread is less than the market, is more negative than the market spread. So here are the results. Let's start with calls in the upper panel. Here's again the call market return that I've already shown you. That's the high minus low call return. The lower bound is 2.94 times the first number, so that's 28%. The difference of the spread minus the call is minus the bound is highly negative, with a t-statistic of almost -4. We do here a one-sided test because the null hypothesis is that the bound holds, so the p-value on this t-statistic is 0.01%. If you do the same on out-of-the-money calls, the market would be 9%. The spread of the high minus low would be close to that, 8.6. But the lower bound would say you should at least get 26% on average. And that is clearly violated, again, highly significant. If we exclude COVID, this doesn't do much for calls. The results are largely the same. If we move on to puts, taking a short position again to make it easier to read, here we have a return on the market of 4.7%. The strategy only returns 1.4. That underperforms the market, and the bound is violated. But we don't have enough power here to reject the null. The p-value is here 18-point-something%. And the same is true for out of the money. But this is only driven by this extreme COVID month. If we exclude the month February 2020 till March 2020, you get these numbers, and just excluding the single month changes the picture quite a bit. The market goes up a bit, 9.8%. The strategy doesn't change so much, 3.2%. And now the bound is still violated, but now we have, since we removed a lot of volatility, have enough power to reject the bound with a t-statistic of -4, and for out of the money, it's still -2.87. All right. Some corroborating evidence on our findings. I will show you two more results that kind of support our main conclusion. So now we'll use machine learning. I will use a neural network to do two things: either predict option returns directly or to predict option price levels. And the main result will be expected stock returns does not predict option returns, but it does in fact predict prices of options. Let me show you the first one. So what I've done here is used a neural network to predict option returns out of sample, and I checked which of the, 227 variables are the most important variables to predict options. And I picked here the top 30 variables. That's the right plot with the respective importance measured as the decrease in out of sample R square. On the left-hand side, you see the top 30 variables to predict stock returns. And these are fewer. Here we only have the about 100 stock level features, because the option features obviously don't exist on the stock level, and also the sample is not long enough. And to make this easier to read, I've highlighted two things. First, in bold font, you see those variables that are in both plots. And there are only very few of those. Only here share turnover is in both of them, this score, firm leverage, and a few others. And as an additional variable, we have used expected stock return directly. Maybe things are too noisy. Maybe the machine cannot figure out how these variables need to be transformed in order to predict option returns. So we put the expected stock return directly, and here's a broken, you can think of this as a broken line. This ranks somewhere around 100, and this is basically irrelevant. And the low overlap in variables also tells you that variables that predict stock returns barely predict option returns. Now we change the idea a bit. The left-hand graph is the same. It's the feature importance, so the decrease in out of sample R square if you predict stock returns. And the right-hand side, now we predict option prices, or we actually predict implied volatilities, because there's more well-behaved. And what you see now is expected stock return comes out as number 7 variable, is seventh most important variable in predicting the prices of options. And again, in bold font, I've highlighted variables that are in both these plots, and a bunch more than before. And even those that are not highlighted, for example, here return volatility, it doesn't show up on the left, but here's some very idiosyncratic volatility down here. So these are very good substitutes. So if you take a closer look, even those that are not highlighted typically have a very close cousin on the left-hand side. So what this shows you on a high level is option prices are systematically related to expected stock returns and components of expected stock returns, meaning variables that predict expected stock returns. All right, some robustness. I've said before, one of the assumptions is that the return distributions are the same across stocks, which they clearly aren't. So we've done double sorts to address for that. We've double sorted on our in our test of our bound on some measures, for example, volatility. Let me briefly show this. So we've sorted based on historical volatility of the stocks in 5 portfolios, and then redone the test of the bound for each of these portfolios. And the main thing to look at is here, in all cases, maybe except this one, it comes out again significant. It is a little bit driven by this volatility dependence of expected stock returns, but nevertheless, the result still goes through, maybe with this exception of this 6% p-value here. But if you do a joint test, whether all portfolios are, whether the bound holds for all portfolios, you again can clearly reject that. For put returns, a similar picture. In 3 out of 5 cases, it holds on the individual portfolio level. But if you do a joint test, that's basically a Gibbons-Ross-Schenken test. If you do a joint test whether the bound holds for all portfolios, you can clearly reject that. And then we've done similar exercises for skewness, kurtosis, implied volatility, and the result always goes through. Then we have some variations of how we construct the test. We have alternative proxies for market returns. We have alternative proxies for the risk-free rate. We have included shorting fees. You already asked for that. So it decreases. What we do is we include the shorting fees using the measure of O'Neill and DEMA. But of course, it goes on both sides of the portfolio. You can also earn the shorting fee on those that we are long. And as a result, it does not affect the stock spread very much. We've included transaction costs. Again, our portfolios are fairly stable. They only have a turnover of about 10% per month. 90% of the stocks stay the same. It increases the stock spread a bit, but actually affects the option spread much more because the transaction costs there are higher. And with options, you have to trade every month. You cannot keep the portfolio constant. And the last point, you might maybe say, well, maybe options are not predictable in the first place. They're super noisy. That's not true. That I've shown you the feature importance. Option returns are well predictable by neural network. And if you were to perform a trading strategy based on the signal out of sample, this works remarkably well. So it's not that option returns are not predictable. They're just not predictable by the expected stock return. There's a question in the chat. It's a direct message to me asking, do you do rebalancing or is that irrelevant? Feel free to unmute and follow up. So we rebalance every month, both the stock and option portfolio. And as I already said, in the transaction cost, we take this into account. Anything that we don't trade, we don't pay transaction costs on. There's a good answer to your question. Feel free to follow up.
Tobias, I got another question.
Sure.
One of the things that worries me, I mean, because I'm also related to, doing all these option returns, is your outliers. I don't know if you are planning to do or deal with that in some way, because, looking at your single shorts, for example, if we use portfolio 8 for calls and puts instead of portfolio 10, then the spread is going to be exactly the same or very similar to the market. Then I don't know if you're planning to deal with that. I mean, some of the option prices are very low. I don't know, focusing on S&P, because, the problem with using option return is like there are many outliers that, they change results a lot. This is based on my experience.
So that's a fair point. Using only S&P, for example, is in our to-do list. We haven't done it yet. We have implemented standard option price filters, whatever, too large spreads, violations of no arbitrage, too low prices. We've taken all of them out. But you're right. If you were to move to here, you have a return roughly to the market, but recall I wanted 3 times the market. I wasn't happy with just the market. The bound asked for 3 times the market. So I haven't done the test. Obviously, that's not 3 times the market. Whether it would be statistically significant, I don't know. My guess is it would probably still come out. But yeah, it's on our to-do list. Thank you. Any other questions at this point? If not, let me show you the last thing I have. Think about potential explanations for the result. I've already spoken about shorting fees. It might be that investors turn to puts because it's expensive or hard to short the underlying. But when we look at the numbers, this cannot really explain the result. You might think maybe these markets are segmented, but this is not really the case here because the option payoff, since we have until maturity, is only a function of the stock return. Only the initial price is set. And I would kind of expect, if these are not integrated, kind of random deviations. Some prices are too high or too low, but that should wash out on average. again, since the option payoff is only a function of the stock return. But what we document is a systematic price deviation. The call prices systematically increase with expected stock returns, and put prices systematically decrease with expected stock return. And that's not what I would have in mind when I think about segmented markets. You might also think maybe there's some other variables in the background that you didn't properly control for, let's say variance risk. It's plausible that high expected stock returns have high returns because they have maybe exposure to variance risk somehow. That would, of course, make calls on these stocks more expensive and would make the spread that we find smaller. So that could explain our results. But on the side of the puts, it would go in the opposite direction. It will make the puts on the high return stocks even more expensive. So the return spread that should be large would be even larger. And then we would need to find the opposite result on puts. And the same logic holds for any other variable you can think of, like liquidity or jumps or anything. It would always have an asymmetric effect on calls and puts. It would make one spread smaller, but then we should find a higher spread on the other side. What we do find, however, is what I already said before, that there's the systematic deviation of prices. That calls prices increase on average with expected stock returns and put prices decrease with expected stock return. And if you write down put call parity, you would see this should actually lead to violations of put call parity. And that's exactly what we find. So to show you this, I run a simple regression. I measure put call parity as an implied volatility spread. That's the same measure that Kramers and Weinbaum use. So you take an at the money call and put pair with the same strike and same maturity, calculate the implied volatility of both of them. Under no arbitrage, these implied volatilities should be exactly the same. In the data, they often aren't. But typically, you cannot trade on this. This would be an arbitrage opportunity if you could trade on the mid price, but typically you can't do that. And these violations are typically well within a bid-ask spread. But anyway, we do this on the mid price, and then we run the following regression. We regress this implied volatility spread on a constant, on our expected stock return, and a bunch of controls. The first column, we have only our expected stock, and all variables in this regression, both left and right-hand side, are standardized to have zero mean and unit standard deviation. So you can compare magnitudes well. Now we add one control by the other, and you see throughout our expected stock return is highly significant and the most important predictor of this implied volatility spread. Yeah. So these violations are consistent with our puzzle, but this doesn't really explain it, because the puzzle is, why would you trade at these prices? It would be much better off using a levered stock position instead of trading calls or puts on the stocks. So that's what I have. What we show in this paper is we ask a simple question. If you know or have a view on expected stock returns, how should you trade that? Should you trade this using options, or should you maybe rather trade this using stocks? And we find in this paper that it's not a good idea to trade this using options, but you're better off doing this in the stock market. Standard option pricing theory tells you that actually shouldn't be the case. That should work very well. Prices of options should be independent of the option price, of the expected return of the underlying of the mu. And then return should be strongly increasing, but the data says the opposite. The data says option prices are driven by mu, are driven by expected stock returns, while option returns are not. Thanks a lot. And I see there's some more questions in the chat, and I'm happy to take questions if you have some.
Great. At this point, if you have a question, please feel free to unmute yourself and use your microphone to shout it out.
I got
Sorry.
another question then,
Yes,
Tobias.
go ahead, Peter.
As you're using aspiration to aspiration, I mean, sometimes there are 4 or 5 weeks. I guess this might be in your advantage, right? I mean, then how do you deal with this also when you compare with stock returns? I mean, because it's not always a monthly return, right? I mean, sometimes we have 5 weeks in between aspirations, and then, you know.
That's true. So yeah, I would need to go back and check. We have tried both. It doesn't matter much. So I think our stock returns are calendar months, and our option returns are expiration to expiration. But I'm not 100. So after expiration to the next expiration, but not 100% sure on this whether the stocks have now exactly the same timing or not. But it's in any case, it's fairly similar. I got a question here as a direct message whether I can clarify what I said about predictability of option returns. So what I said is option returns are in fact predictable. There are some variables that predict option returns very well. Can go back here to this graph. For example, option returns are well predictable by illiquidity of the underlying, by the turnover of the underlying, by the variance spread, the moneyness of the option. 0 trading days is another liquidity measure, and so on. But these variables are very distinct from the variables that predict stock returns. So they are predictable, but they're not predictable by variables that predict stock return or by the expected stock return itself. Yeah. Any other questions?
I have a comment. I'm really not an academic, I'm a trader. But what happens sometimes in some of these issues, the volatilities go to extreme levels. So if you're buying calls or buying puts, chances are that your returns are going to be low. So that may be one feature. The other is the CBOE has a measure now of meme stocks. They keep this internal, but I got some where the volume of these meme stocks, of course, those stocks have been have had extremely low returns, and there's a race to go one way or the other in some of these stocks, and you may be picking up some of that in your data.
So let me answer the first one and then follow up on the second. You're right, that implied volatilities can maybe be very high, but we don't take a stance on that. You can entertain any pricing model you want that gives you whatever implied volatilities you want to have. What we care about is the spread. If just the level of implied volatilities or something goes up, this wouldn't affect our result because we're looking at a spread between two portfolios. And on the second one, I'm not so sure. Of course, all these meme stocks are somewhere in the sample. I'm not sure how significant they are. On average, we have, I think, 3,000 stocks, so 200 to 300 in each portfolio. So they shouldn't be too material, I guess. Is this a good answer to your question?
Yeah, this is what you've discovered here is perplexing, though. That difficult to explain why.
Yeah, we don't have a very good explanation either. I mean, it seems like some traders are trading in the direction of the expected stock returns, and somebody distorts the prices in that direction. But nevertheless, it's puzzling why the prices are where they are, or why is somebody willing to trade at them.
You didn't have specifically skew in as an independent variable, the implied volatility of the 25 delta call versus the 25 delta put.
We do. It
do?
wasn't on the list of 30 variables, but we have it.
But it didn't come out to be significant?
It didn't come up as one of the top variables, no.
Okay.
So,
I'm
oh, yeah, Dima.
Yeah, just one quick comment. Neil already kind of asked about the borrow fees, but one of the difference between option returns and stock returns, option returns already include the borrow fees and stock returns don't, so you need to explicitly account for them. So maybe like excluding like 10% of stocks with the highest borrow fee would be would be useful to see how the result change.
You are right about that. Let me take that down.
I mean, in the options, you pay any carry cost up front, right? So all of
Yeah.
those kind of things.
Yeah.
While in the stock returns, where all of those dividends, borrow fees, all of this other stuff.
No, you're right. If I remember correctly, the spread in borrowing fees between the high minus low, I think, was 6 basis points per month, if I remember that number correctly, at least in that magnitude.
Okay.
So out of the 204 basis points, this doesn't do much damage to the returns we report. Yeah.
And for stock predictability, 2002 is very special, right? Because like many of their stock-based signals really like became much weaker post 2002. I wonder whether you can use it in any way or form.
In what sense do you mean?
Well, like just after 2002, predicting stock returns became much, much harder for whatever reason.
I agree with that. Everything we do is past 2002, as
Okay.
you've seen. Does this
Okay.
answer your question?
Yeah.
Okay. I see a raised hand. Go ahead.
Yeah, so how to interpret your result? The two questions I have. One is that one side has to make money, right? So are we saying that, I mean, is the model wrong or are the people wrong? And then the second question is in terms of can we think of this as a casino where people want, they get a kick out of trading options, and therefore the option market makers or somebody is supplying them with very high cost of liquidity, right? Who's making money then, right? I mean, so somebody is making money. One of the two sides will make money.
That's true. To know who's making money, I would need very detailed data on who is trading, the identities, who trades what quantity. That is very hard to answer. I'm not so super sure whether this data exists. There's some papers taking a look at that, and typically it turns out that probably, as you might suspect, the market makers tend to make or it looks like the market makers make the profit and somebody else is losing out, mostly not professional traders. But that's hard to say on a very precise level. And the second question, is this a casino where people just enjoy their trading and are happy to lose money? That might be true, that at least that some people do that. Still, the prices are at a puzzling level, and these are competitive markets. So if you understand what's going on, you may happily be willing to supply these options at more competitive prices and get them where they, in quotations mark, should be. Unless you think everybody has these preferences, but yeah, I'm not so sure.
Yeah, I think that may have been maybe the risks being underestimated or something. There are so many parameters in the model, right? And Damit, you were saying it is very hard to predict anyway, even the stock prices. So then how will somebody predict the option outcomes? Anyway, thank you.
I agree, but what you're testing is we have a decent predictor of expected stock returns, and they were just saying, well, what if I trade options on them? They should do well in theory, but turns out not to do so in practice.
Right. Thank you.
Welcome.
Okay, Tobias, I don't know if you see, I think there's one more question in the chat.
Let me have a look. What?
From SW?
Yeah, I see that. So I read it out. What if the retail traders cannot predict mu, so the expected stock return, as well as market makers? Is that the explanation? Market maker make money and retailers lose money. That could be, but it depends on the direction of which side you are on and how your hedging behavior looks like. So yeah, I would need to think that through and also would know the positions data, and that's probably also not constant over time. So of course you could think of market makers want to sell a certain type of option and make it more or less expensive to get themselves the exposure to the underlying. But why don't they trade directly in the underlying themselves? I'm not so sure why they should need to go that complicated route through the options market. But could be. But anyway, the same answer from before also applies. The prices are puzzling, and there's a competitive market. If these prices are somehow distorted, you could step in and sell them at a more competitive price. No, we do not include 0-day options. This is all monthly. So this is 3.5 or 4.5 weeks to expiration, and then we hold them until maturity.
Well, that will definitely be food for thought, Tobias.